Silver just blasted past $117 an ounce as its recent high. WAX now trading around $112 to $113. Gold smashed through $5,000. Palladium, platinum, natural gas, physical hard assets across the board are ripping faces off in vertical moves that most traders haven't seen in their entire careers. Meanwhile, Bitcoin, the so-called digital gold, the asset that was supposedly built for exactly this kind of fiat crisis, is sitting at $88,000, flat, dead in the water. In some periods, actually down, while metals are going parabolic. Let me say that again, because this is the story nobody in crypto wants to talk about. Silver is up over 270% in recent months. You're 270. Gold hit $5,100 per ounce. And Bitcoin, the fixed supply digital asset that every maximalist told you would explode when paper money melted down, can't even hold a rally. What does that tell you? This is the fiat crisis Bitcoin was built for. It's not her. Except it's getting absolutely destroyed by physical metals. And if you don't understand why, you're going to miss one of the most important macro shifts happening right now. So let's connect every single dot. To start with the numbers, because the divergence is stunning. Silver market capitalization in this environment has now overtaken Bitcoin's total market cap. Read that sentence twice. A metal that gets dug out of the ground, that you can hold in your hand, that's been money for 5,000 years. It's now bigger than the entire Bitcoin network in market value, during what's supposed to be Bitcoin's moment. Gold is sitting at record highs around $5,000 to $5,100 per ounce. Physical premiums on silver bars and coins are spiking, as dealers struggle to source material. And what's Bitcoin doing? $88,000, with billions in short liquidations bleeding out recently as leverage longs get crushed. This isn't a small gap. This is a total decoupling. And the question everyone should be asking is simple. Why? The mainstream narrative you've heard for years is that Bitcoin is digital gold. Finite supply, 21 million coins, can't be printed, perfect hedge against fiat debasement, store of value for the digital age. When central banks go insane and governments print money into oblivion, Bitcoin moons. That was the pitch. That's what millions of people believed. And right now, in what looks like an actual dollar crisis, with commodities screaming higher, Bitcoin is getting left in the dust. So either the narrative was wrong or something deeper is happening that nobody wants to admit. We are not in a broad fiat collapse. We are in a targeted dollar crisis, and that distinction matters more than anything. The US dollar is weakening significantly against the yen, the euro, the pound. The Federal Reserve has intervened in currency markets, that's documented, to try and stabilize the yen-dollar cross. The United States is facing government shutdown threats, political chaos, and massive debt refinancing pressure. Over 1/3 of US debt needs to be rolled over this year alone. That's trillions of dollars that have to find buyers in a market that's increasingly skeptical of dollar-denominated assets. When the dollar weakens, commodities priced in dollars rally. That's Econ 101. Gold, silver, oil, copper, natural gas. They're all denominated in US dollars globally. So, when the dollar drops, it takes fewer euros or yen to buy the same ounce of gold. Foreign buyers pile in. Domestic holders see their purchasing power erode and flee into hard assets. This is a mechanical relationship that's played out in every major currency crisis, from Weimar Germany to modern Turkey to Zimbabwe. And it's playing out again right now. But here's the part that's breaking the Bitcoin maximalist thesis. The physical hard assets are absorbing the flight to safety bid. Digital assets are not. Why? Because in real stress, in genuine uncertainty, where people don't know if their government can pay its bills or if the financial system stays stable, investors are dumping liquid assets to raise cash or move into true safe havens. And increasingly, the market is treating Bitcoin like a liquid risk on trade, not like digital gold. Watch what happens during deleveraging events. Crypto gets hit harder than almost anything because it's easy to sell. It trades 24/7, and it's viewed by most institutional players as a speculative asset or not a safe haven. When margin calls come in, when funds need to meet redemptions, when uncertainty spikes and people want liquidity, they sell Bitcoin. They don't sell it because they hate it. They sell it because they can. It's the easiest thing to turn into cash. And that's exactly what we're seeing. Billions in realized losses on Bitcoin shorts and leveraged long liquidations while metals grind higher day after day. Gold and silver, on the other hand, get hoarded. They get pulled off the market. They get locked in vaults. Physical buyers aren't selling into this rally. They're adding. You see it in the COMEX registered inventories, which have been under pressure for months. You see it in Shanghai Gold Exchange premiums, which remain elevated. You see it in retail demand for coins and bars, where dealers can't keep product on the shelves. This is not speculative froth. This is real accumulation by people who understand what tangible assets mean when trust in the system starts cracking. And here's the reveal that reframes everything. Bitcoin isn't failing because it's a bad technology, or because the 21 million supply cap doesn't matter. Bitcoin is failing right now because it's abstract. You can't touch it. You can't hold it. You can't bury it in your backyard or lock it in a safe and know with absolute certainty that it's there, regardless of what happens to the internet, the power grid, the banking system, or the regulatory environment. In a crisis of confidence, tangible beats digital every single time. That's not a criticism of Bitcoin's design. That's just human psychology that's been true for thousands of years. Think about what silver and gold represent. They're elements on the periodic table. They exist independent of any government, any corporation, any network. They've been money longer than any empire has existed. When you hold an ounce of silver, you're holding something that was valuable in ancient Rome, in imperial China, in the California gold rush, and it will still be valuable 100 years from now. There's no counterparty risk. There's no code vulnerability. There's no regulatory threat that can erase it. It just is. Bitcoin, for all its advantages in portability and divisibility and censorship resistance, doesn't have that same visceral tangibility. And in moments of real fear, not theoretical fear, not the fear you feel when you're up late reading macro Twitter, but the fear you feel when you genuinely don't know if the system holds together, people reach for what they can touch. That's what we're seeing. The market is voting with capital flows, and the vote is overwhelmingly in favor of physical. Now let's talk about the technical setup, because even in this chaos, there are levels that matter. See, silver broke through a massive multi-year resistance zone, around $32 to $35 months ago. That breakout triggered algorithmic buy programs, momentum funds, and a wave of technical-driven buying that pushed prices vertically. The move from $35 to $70 was fast. The move from $70 to $110 was parabolic. And the spike above $117 recently was pure capitulation. Shorts covering, FOMO buyers chasing, physical premiums spiking, futures markets dislocating from spot. Gold's rally has been steadier, but just as relentless. The break above $2,700 per ounce was the key technical signal. From there, it's been a grind higher, with periodic explosions, through psychological levels, 3,000, 4,000, and now 5,000, with momentum indicators like RSI, still not showing extreme overbought conditions on the weekly charts. That tells you this move has legs. It's not a blow-off top, driven purely by emotion. It's a structural repricing of gold, in a world where trust in fiat currencies is eroding faster than central banks can print. Bitcoin's chart, by comparison, looks weak. The failure to break convincingly above $90,000 while metals were launching was the first warning sign. The subsequent rollover and inability to hold key support around $92,000 confirmed that buyers weren't stepping in with the same conviction. Volume profiles show distribution, not accumulation. Realized profit and loss data shows long liquidations outpacing short covering. This is not the setup you want to see in an asset that's supposed to be a macro hedge. But here's where we need to inject some balance, because I'm not here to tell you Bitcoin is dead or that crypto has no future. That's not the point. The point is to understand what's happening right now in this specific environment. And right now, Bitcoin is being treated as a risk asset, not a safe haven. That could change. Maybe it changes tomorrow. Maybe it changes when the dollar stabilizes, or when equity markets find a bottom, or when regulatory clarity improves. But today, in this moment, with these capital flows, physical metals are winning, and Bitcoin is not. There are legitimate bearish factors for metals that we can't ignore. Industrial demand for silver, which has been a huge driver of the deficit story, could weaken if we hit a global recession. China's economy is slowing. Europe is barely growing. US manufacturing data has been mixed. If industrial offtake drops significantly, that removes a key pillar of silver's bullish thesis. Or gold, while less tied to industrial use, can still see profit taking at these levels. $5,000 per ounce is a psychological magnet for sellers. Miners are hedging. Central banks might slow their buying. Technically, both metals are extended and vulnerable to sharp corrections. And Bitcoin, the bearish case is that it's still correlated to risk assets like the Nasdaq. If equities roll over hard, Bitcoin likely follows. Regulatory uncertainty remains, especially with new administrations and potential crackdowns on stable coins or DeFi. The narrative that Bitcoin is digital gold only works if people believe it. And right now, the market's behavior suggests that belief is being tested and found wanting. But here's the immediate bullish counter-escalation that matters more. The dollar crisis isn't over, it's accelerating. Debt refinancing needs are growing. Political dysfunction is worsening. The Federal Reserve is trapped between inflation and recession, and every policy choice they make creates new dislocations. Commodities priced in dollars will continue to benefit as long as dollar weakness persists. And dollar weakness is structural now, not cyclical. This isn't a short-term dip. This is a multi-year trend driven by unsustainable fiscal policy, trade imbalances, and the slow erosion of the dollar's reserve currency status. Physical metal supply is still constrained. Silver mine supply is not keeping pace with industrial demand growth from solar, EVs, AI data centers, 5G infrastructure, and defense applications. The deficit is real, inventories are falling, Above ground stockpiles are being drawn down, and unlike Bitcoin, you can't just mine more silver by plugging in more computers. It takes years to bring new mines online, and exploration budgets were slashed after the last bear market. The supply response is lagging badly. Geopolitical fragmentation is another massive tailwind. China has implemented export controls on critical minerals. The US is reshoring supply chains and imposing tariffs. BRICS nations are diversifying away from the dollar and buying gold. Central banks set a record for gold purchases in recent years, and that trend is continuing. This isn't speculation. This is documented, reported, verifiable activity by sovereign entities who manage trillions in reserves. They're buying physical metal, not Bitcoin. And here's the kicker. If Bitcoin does eventually catch up, if it starts acting like the digital gold it's supposed to be, metals will likely rally even harder alongside it because the underlying driver would be the same. Total loss of confidence in fiat currency systems. The scenario where Bitcoin moons and metals collapse makes no sense. They're not inversely correlated. They're both alternatives to fiat. So the current divergence is either temporary and Bitcoin catches up, or it's revealing something fundamental about what assets people actually trust when the system is under stress. Let that sink in. The crypto bell is ringing loud. The maximalists are screaming that this is Bitcoin's moment. And yet, nobody's buying. Or more accurately, the people who are buying silver and gold instead. They're voting with their money for tangible over digital, for 5,000-year track records over 15-year experiments, for physical certainty over cryptographic abstractions. Does that mean Bitcoin has no place in a portfolio? No. Bitcoin has unique properties. It's portable across borders in ways gold will never be. It's divisible to 8 decimal places. It's resistant to confiscation if you manage your keys properly. For people in countries with hyperinflating currencies or authoritarian governments, Bitcoin is a lifeline. Those use cases are real and valuable. But as a macro hedge in a dollar crisis, the market is telling us right now that Bitcoin isn't performing the way the narrative promised. So where does that leave us? 3 key takeaways. 1. We are in a targeted dollar crisis, not a broad fiat collapse. That distinction explains why commodities are rallying and Bitcoin isn't. 2. Physical hard assets are absorbing safe haven flows because tangibility matters more than most crypto advocates want to admit. And 3. This divergence won't last forever. But until Bitcoin proves it can act as a store of value in real stress, it remains a speculative asset, not digital gold. The unresolved tension is this. If the dollar crisis deepens, if debt spirals out of control, if inflation comes roaring back, or if deflation crushes growth, what breaks first? Does Bitcoin finally catch a bid as the ultimate non-sovereign asset? Or do metals continue to run while crypto bleeds? I don't have that answer. Nobody does. But the capital flows right now are clear, and ignoring them because they don't fit your thesis is a mistake. For holders of physical metal, this is vindication. The thesis is playing out. For Bitcoin holders, this is a moment to reassess, not panic, not capitulate, but ask hard questions about what you actually own and why. For people sitting in cash or short-term treasuries watching this unfold, the message is that doing nothing has a cost. Inflation is eating you alive, even if nominal prices look stable. Do your own research, verify every claim, understand the risks. Nobody knows how this ends, but the signals are there for anyone willing to look. Silver spiking to 117 and recently, now at 112 to 113. Gold at 5,000. Bitcoin at 88,000 and flat. Connect the dots. Invest with logic, not hype.